Brad Williams, Frugal Finance. Here's a sore point that you, as an investor, may simply overlook. And because the financial institutions out there love to play their game, here's their latest and greatest little trick. Within your investment account, you usually have what's called a cash sweep component. It sweeps any liquid assets over into a quasi savings account. Now, in the past, when things were not as screwed up as they are today, sweep accounts would move money into short-term Treasury type investments where the return was sensible. Old days, you'd have a savings account. That would be the equivalent. Now, the unscrupulous and never-ending tactics of these financial institutions differentiate sweep funds from money market accounts. There's a huge, huge difference. Sweep funds you're going to earn absolutely nothing on these horrible friggin' instruments. It's just a tactic for the Schwabs, the Fidelities, the Morgan Stanleys, the Merrill Lynches to make money because you overlook it. We all do. Take a look at your financial statement. Take a look and see if you're in a sweep fund. See what you're making. And here's the reason why these financial institutions do this. Because it takes one extra step. You actually have to physically go in and buy a money market fund. They're liquid. You can buy and sell on the same day. But if you have 10 grand and it's in a sweep fund, you're going to earn 0.000 nothing. Whereas today, here we are in the ending part of January 2025, and there are money market funds that are paying 4.25%. Now you can see why the financial institutions and their greed is going to divert you from doing this. So you have to physically go in and buy a money market fund. Now there's, the last I looked, and I don't know, check up here on the right. I was checking the other day, there's 625 money market accounts out there. Different. And it could be PIMCO, it could be Schwab, it could be Fidelity, it could State Street, Goldman, any in the number of companies. It's up to you to do your investigation. You see right here, this fund analyzer? Okay, I'm going to take a little curveball here. This way you don't have to link to it. Go to fund analyzer. Again, this is FINRA supported. Now, what you're going to need to do is go in and put in money market. What you have to do is you have to go to product type. And then right here, it says money market fund. You're going to have to click this. And here you go. You can see there's money market funds, and then there's all this other junk. So what you have to do, this is their expenses. Don't get confused. This is not the return. This is not the return on your money market account. This is what they charge. So you want to go through here. There's 900. Nah, that's not right. Money market funds. Okay. This particular resource is somewhat limited. You're going to need to know a name. In other words, you're going to see BlackRock. You're going to see John Hancock, JP Morgan, Federated. Like I said, there's 900 different deals here, and you're not going to see them all because it stops. It says define your search. So we can go here to, because this is a recognized name, a lot of you don't understand who Goldman Sachs is or Fidelity. Well, here's Fidelity, but you can go and put SCHWAB, Schwab, just click it, go Schwab funds, and here you go. There's 79 different funds. Now it's up to you to figure out what is what. Some of these require a lot of money. That's why their return is a little bit higher. Some are for the retail investor. Take a look, and you want to just go through and see. It's money market tax-free, money market tax-free, money market taxable. Understand what you're looking at. Then once you go in here, you can take a look, and it'll just give you their overall breakdown of their expenses, and that's critical. You want to look at something with very low expenses and try to take advantage of it. Another resource, if you have a lot of cash and you understand Treasury Direct, you can bypass all this and do this on your own and buy short-term treasuries through the government, and you won't have to deal with these fees. Anyway, What is a money market? Money market funds are a type of mutual fund that invests in assets that are generally easy to convert to cash, sometimes called cash equivalents. Those money market funds are managed with the goal of providing low volatility and principal stability. These products are often used by investors who want a safe place to store their money in the short term. Okay, now, if you go in to any of the different money market funds, like I said, you can go in and you can buy and sell on a daily basis. Now, here's the deal. Some of these are not FDIC insured. That's a key concern. Make sure you read the prospectus. Some have SIPC insurance, some do not. And to bypass all this, as I said, you can go up to Treasury Direct, and I may have a link up here that will take you to Treasury Direct. Let me point this out straight up. It is a legacy software program. It is clunky. It works. I've been using Treasury Direct for 20 plus years. It's just a matter of you feeling comfortable working with a GOV type instrument. What's inside a money market fund? Now be careful here. Even if you read the prospectus, you won't know all of the components. If you buy strictly a Treasury related money market account, it will be strictly Treasury related investment. You can have a generic money market funds where it could have Treasury bills, commercial paper, banker's acceptance, and CDs. You can have one strictly Treasury bills. Now, commercial paper is a short-term debt instrument issued by corporations that pledge to repay a specific amount at a particular rate. In other words, if you're General Motors and you have short-term cash needs, well, they'll issue 7-day commercial paper. It's comparable to the Treasury rate, maybe a little bit higher, but it's typically AA rated, maybe A rated. Now, here's the deal. There are some instances where you, as a money market investor, are looking at revolving type. Well, they can use any kind of verbiage, but in the back end, you could be investing in credit card components. In other words, investors, big time banking institutions, they'll package up credit card receivables where they're making 16, 18%. Then they'll strip them down and they'll put their best pieces, they're called tranches, into money market accounts. They're going to be higher earning investments. But look, it's a credit card. You don't know the charge-off rate. So be careful. And it's hard to siphon or filter that information out. So when you look through this stuff, make sure you know what you're investing in. There are cases where you're going to read the hype on the internet about the highest paying money market accounts. Well, the reason, if the average is 4.5% and you have some marketing pitch about, well, this particular money market account's paying 5.5%, where the average is 4.5%, you got to ask yourself, what are they investing in to bump that up, and how risky is it? How do money market funds work? Money market mutual fund investors receive dividend income that reflects current short-term interest rates and is redeemable on demand. In addition, a retail money market fund is managed to keep the fund's net asset value stable at $1 per share. This is critical because there was a run on cash. This was during the 2008 meltdown. It was called, they broke the buck. In other words, this net asset value dropped below $1. So new law stepped into place, and now you have a little more reassurance that this dollar will always be a dollar. Now, there's no guarantees. If you find a little uncertainty here, then look at Treasury Direct or invest strictly in a money market account that is Treasury only. But nonetheless, if there's a run on money, you don't have control over this. Now, in some cases, the financial institution can freeze withdrawals, and that's not a good thing. But keep all of this in mind. When I mean freeze, that means to prevent the run on money, the Federal Reserve says, we're going to slow down any withdrawals. So for example, Lehman Brothers, there was such a huge demand for the money from Lehman Brothers that when BK in 2008, it impacted the entire global economy. And subsequently, when you have that huge rush of money being pulled, okay, Silicon Bank, 3 years ago, they went upside down, or 2 years ago, They went upside down. What happened? Well, sentiment, and then you had a lot of the venture capitalists in the Bay Area. They had billions and billions and billions of dollars in Silicon Bank, and they just said, well, you know, there were a lot of rumors. And again, there's always the buy the rumor, sell the fact. In this case, it was sell the rumor, buy the fact. There was a huge withdrawal, and subsequently Silicon Bank was taken over. There's always risks. There's always risk, even in money market accounts. But keep in mind, I opened this up with these sweep accounts. They're horrible. They're just a way of these financial institutions, and you just saw there were 900 different money market accounts. So imagine all of the billions and billions, maybe trillions, of your hard-earned money sitting in a sweep account earning nothing. So now you have to take the extra step and go in and physically put in a trade and make sure that you are in a money market account. Or, I understand Fidelity. Well, in the past, like I said, in the past, when I was doing this, the financial institutions were less greedy, and sweep funds went into a reasonably earning account. Now, the types of Schwab's and Goldman and the other accounts have these sweep accounts that pay nothing. It's just shameful. Capital One was sued the second week of January for $2 billion for doing the exact same thing. They had Money Market Fund Plus. That was a sweep fund paying nearly zero. Then they had Money Market Fund Plus Plus. That was paying 4.5%. They didn't tell the consumer that, look, you have this option. All you have to do is check this box and you're going to earn 4.5% on your liquid asset. So I hope Capital Bank gets spanked with this $2 billion lawsuit. And I hope that leads to all these other financial institutions falling under that same requirement that they need to sweep the money market accounts into reasonably paying instruments. Anyway, I can go on and on and on, but you can see that on the front that a money market fund is just nothing but a money market fund. Pretty boring, but leave it up to the bean counters and the greed of Wall Street to screw the consumer. And again, it's up to you to do your due diligence. So let me know. Let me know of any sensible money market accounts you've had good experience with, or have you fallen victim to the shenanigans of Wall Street? Brad Williams, Frugal Finance. Hope that helped. Thanks for watching. See you soon.